Good day. My name is Lakshya Behl. Welcome to Behl's Business Broadcast. Today we are talking about the consequences of inevitability. As usual, we'll talk about how to look at the current economic environment and how to use that to grow your business, to position your business in a way that you can grow rapidly from where you are to where you're going to be. So let's get started with some healthy dose of news from the last week's top things that happened in the world and in the world of finance. Last week, I actually talked about this interstellar visitor, this comet, which has now sprouted 7 jets after a flyby around the sun or near the sun, because astronomers are now closely tracking an interstellar visitor that has exhibited unexpected behavior following its closest approach to the sun, including a velocity shift and the emergence of at least 7 distinct jets emanating from its surface. The object, designated as 3I Atlas, passed the perihelion on October 29th at approximately 203 million kilometers from the sun, which in astronomical units is very, very close to the sun. And since then, NASA has confirmed that the object is experiencing non-gravitational acceleration, movement that cannot be explained by gravity and the forces exhibited by gravitational fields. What that means is, people have no idea what's going on. Its velocity is shifting in a way that is unprecedented, that is unexpected, which leads some into concluding or at least suspecting that something strange is going on. This might actually be artificially accelerated. This kind of behavior is normally only exhibited in vehicles or in spacecraft that are controlled by external propulsion mechanisms, not necessarily controlled by free fall across gravitational fields. The reason why I bring this up is because now we have competing explanations. So some in the scientific community are suggesting that the jets might represent thrusters for spacecraft navigation, though he acknowledged they could also be associated with ice pockets on a natural cometary nucleus. Mainstream astronomers maintain the phenomena are consistent with natural cometary processes. This is the usual, some people are saying, while it is clearly unusual for others. And jets can point sunward when volatile ices sublimate unevenly from a sun-facing surface. So some are saying that all evidence points to this being an ordinary comet that was ejected from another solar system. The point is, nobody knows the truth, and that brings us to the crux of our tenets, especially in terms of business, that nobody has a crystal ball, nobody knows what's going on, and your best bet is to test your hypotheses, form intelligent hypotheses which become more intelligent as you gain more experience with your business and you work with people who are a little bit ahead of you, who you can seek their mentorship, their peership, their mastermind advice on your situation. And if they are a little bit ahead of you, they can help you form intelligent hypotheses, which more often than not can be validated. But at the end of the day, nobody knows the truth, not even you, about why things have worked so far, why what is working today is continuing to work today, and whether or not it will continue to work in the future. Nobody knows that. It's always going to be in a state of flux. So all you can do is test your hypotheses cheaply. In fact, in my last live stream, I talked about how you can test for just a few $100s the validity or invalidation of a hypothesis, and if it works, how you can scale it for as long as it works. So go ahead and watch that live stream if you haven't done so already. Okay, we have new records on streaming platforms, which is going to be in line with what we are going to experience through the economic situations or circumstances that are building up. And as we navigate today's news, you're going to find out why this is important. Now, this is the big news from last week. Trump has now proposed a 50-year mortgage to help with the increasing housing costs. We talked about this. We've been talking about this for weeks now. And while nobody could have seen this coming, 50 years of mortgage, it is essentially the same thing. It's the same thing in principle, where you borrow from the future in order to sustain yourself today. Here's the funny thing. The interest rates are correlated with the length or duration of the payment terms. So if you have 50-year interest payments, they're going to be higher than the 30-year interest payments we're looking at today. So let's say currently 30 years are approximately 6%. Well, 50 years are probably going to be 7%. And what that means is while your payments over the months will go down, your monthly payments will likely go down, they won't go down as much if this proposal is approved and you end up having 50-year mortgages. So if on a 30-year mortgage, for instance, you have a $5,000 monthly payment, you're probably going to have $4,400 or $4,500 a month payments on a 50-year plan. The flip side to that is you'll be paying a whole lot more interest, a whole lot longer before you start building any equity into that property, into that real estate. Now, there's also another flip side to that. If you can borrow money at 7% for 50 years, while you can also generate 11 to 15% per year on the stock market, well, essentially, you've found a loophole to print unlimited money at 4%. But the reality is stock market is risky, and most people sell their houses around 12 years of ownership. And with this 50-year plan, you may not have much, if any, equity built outside of the inflation-related or appreciation-related value increase of the underlying property. That would obviously be yours, but you would not have paid any serious amount of money on that borrowed principal that you have from the bank or from the lenders. So that is what we are looking at. And we'll talk about why this was sort of coming. I mean, this is an unexpected move, but this is also sort of a same but not very different thing. Like, it's very different. It sounds very different because we've had 30-year mortgages since 1940s, 1950s, but now we have 50-year mortgages that are being proposed. Remember, this is just a proposal. This has not been approved yet, and there's going to be legal stuff to deal with because 50 years is a very long time, and a lot of financial analysts are not happy about it. A lot of personal finance specialists are not happy about it. Me, I'm ambivalent. For me, the world works the way it works, not the way you want it to. I don't care how they make it happen. I don't care what they do as long as I can respond to it in real time. I'm agnostic about the changes that come about in the world. If my business can move and be adaptable, and if I can move personally and be adaptable to the changes that are coming, then I don't care what they do. But for most people, this seems to be a problem because most people are not ready to adapt to the realities of what's coming next. But here's something to consider. If this does happen, if the 50-year mortgage does become a real thing, a lot of people are going to take it. Especially if credit approval becomes easy and the payments are low enough, or the difference between the payment that you would owe on a 30-year mortgage and the 50-year mortgage are low enough that people can actually enter the housing market, people can actually get the market moving, then it will happen. Remember, a lot of personal finance people still also talk about not going for the 30-year mortgage plan if you can pay it back in 15. And if you can repay your house in 10 years, just go ahead and do that, they would say. My philosophy on that is different. My philosophy on that depends upon, it's not a blanket philosophy. So I believe in agnosticism. I believe in being adaptable to your own situation, to the situation of the market, to the availability. And if you can lock in for a very low period, for a very low interest, for a long period of time, a interest rate. So let's say the interest rates go down and you can get a 50-year interest rate for 3.5%. I'm dreaming, I know. This is a once in several decades event that happens. But if this happens, I'll be locking myself into as much capital as I can, as much borrowed capital as I can over 50 years for 3.5% a year. And here's why. Inflation is always going to increase the prices of everything. Even if the inflation comes down to near zero, which it never happens, people are economists, specialists, economic advisors. They're very happy with 2.5% inflation rate or 2% inflation rate. That's their target. 2% is their target. So if the prices keep going up by 2%, well, over 50 years, right? 1.02 to the power of 50. Remember, if inflation is at 50%, at 2% over 50 years, then the prices nearly triple. Now, we all know that when prices triple, if you borrow $1 million, they're essentially only worth $350,000 or $400,000 in this example, right? So over time, the value of your liabilities goes down. So if I can borrow money at a very low rate for a very long time, I'm typically going to get it because I'm not going to spend it on cars or private jets. I'm going to spend it on growing a business, growing my investment portfolio. Bitcoin has historically done 50% per annum, even higher in the initial stages. Now it's coming down. It's getting closer to SPX, but eventually it's probably going to stabilize around SPX, maybe a little bit higher for a while. And if I can borrow at 3% and make 15%, 20%, 25%, I'm just going to keep doing it and keep getting richer while the value of the money that I have borrowed goes down. Why? Because things do tend to get expensive. If you have assets, if you have hard assets, they do tend to get expensive. But anyway, you have to analyze your own situation with respect to these 50-year mortgages. And for now, we're just talking about the economic environment and how it's shaping up and how you should be positioning your business to take advantage of this. So let's get going. Let's keep going. 1/3 of conservation projects abandoned within years, and that's basically just to go on to show you. You can read this article. By the way, I look at perplexity.ai because it looks at many different sources. So it has looked at 90 different sources, and you can look at all the individual sources to aggregate news for you. This means you're not really getting biased news. You're really just getting the essence of the facts of the news. That is what I use. I have Perplexity Pro, and in a lot of ways, if you're just looking at one news source, you're probably looking at biased news sources. This is why I look at Perplexity, and this is why I'm also discussing this particular topic, because what happens is, so here's what I want you to understand. A lot of these statistics about, oh, this study said that, and this study is going on, and we have thousands of studies about that. A lot of those studies, a lot of those efforts, a lot of those projects are just abandoned, but they still constitute, in many cases, a sort of data set of what's going on. So someone comes up to you and says, oh, these projects continue to be counted in official reports, and so we have 1,000 projects going on with XYZ project, right? That's what they're saying. Essentially, most of them get abandoned. Most, if not all of them, get abandoned within a few years. Why? The funding dried up, the interests changed, but they remain in the official statistics. They remain within the official maps of what is going on, in the official narrative of what's going on. And then based on those narratives, policies are made, decisions are made, but it's all based on flawed data. In other words, you cannot rely on data that you're getting from someone else, even if it's official sources. Now, if you do rely on that, and if it's working out for you, great. But if it's not been working out for you very well, I suggest you stop relying on official data, because it can be very, very biased, as we've seen with inflation, okay? Inflation is supposed to be 4%, 5%. But I know for a fact that people's grocery carts, even if the items within the cart did not change, have become significantly more expensive over the last few years. We're not looking at 4%, 3%, 5% inflation. We are looking at significantly higher inflation rates than the official figures. And that happens with everything. So if you just trust the official figures, well, at least form your hypotheses and then test them or validate them or invalidate them by yourself. Otherwise, you're just shooting into the dark and you have no idea what you're working with. Hard data is the only data that matters to you. It's your KPIs. Everything else is a narrative around your KPIs, and you need to understand that. Peter Thiel is saying that housing crisis is pushing millennials towards socialism. That's partly true. It's partly also not true. You understand that there's a lot of job cuts being going on, or a lot of jobs being cut on account of AI and a whole host of other factors. Housing crisis is just one word to encapsulate the entire ecosystem of economics that we are looking at right now. People don't have jobs. They have huge mounting school-related or college-related debts. They have no way of being able to pay for their own accommodations, for their own gas, their own groceries, and it's becoming more and more hard for them. So that makes people think people like Peter Thiel or other economic advisors think that people are shifting towards socialism. It's not exactly a shift towards socialism, in my opinion. It's more a shift towards demonstrating dissatisfaction with the current environment. And when you have GOP in power, when you have Republicans in the House and the Senate, Republicans in the White House, Trump in the White House, then people express their dissatisfaction by electing Democrats, which is what they did last week, which is what we've been seeing. One thing is for sure, though, housing crisis is something that you cannot deny. We have a glut right now. The sellers are not reducing their prices. The buyers are not able to buy the properties that they want. So we have untold levels of unsold inventory, and that level is increasing at 10-year highs, or the level of unsold inventory on market is going towards 10-year highs and even beyond. And we'll find some statistics to show you about that in our upcoming streams. We've talked about that in the past. But Trump is now proposing the inevitable, and I'm going to talk about this in a while. But basically what we've got here is that Trump is proposing the inevitable. He's proposing, let's go give funds directly to Americans. Now, one way of doing that is by what he's proposing here, sending health subsidy directly to Americans instead of Affordable Care Act or Obamacare. And he's saying, I'm recommending to Senate Republicans that hundreds of billions of dollars are currently being sent to money-sucking insurance companies in order to save the bad health care provided by Obamacare. Be sent directly to the people so that they can purchase their own insurance plans. Much better healthcare. That's what he's saying. Essentially, the political solution always comes down to putting more money in people's hands so that the amount of satisfaction they have with the administration grows. So that's what we're looking at here. Let's look at the next one. And this is all adding up to the uncertainty principle, or the inevitability that we keep talking about. But we'll talk about that in greater detail right now. Okay, more flights are getting grounded. Shutdown continues for 40 days. So that is more unrest, more dissatisfaction. Despite all that dissatisfaction, though, here's something to consider. NVIDIA has ordered 50% more wafers from TSMC, that is the manufacturer of the silicon chips, right? And that is because of unprecedented amounts of demand related to AI chips, Blackwell chips, which is the newest generation of graphics processing chips that people are using for AI. NVIDIA builds the GPU, we also build the CPU, the networking, the switches, so there is a lot of chips associated with Blackwell, and essentially it comes down to NVIDIA having a lot of demand, mostly driven right now by AI. Gamers are not driving this demand, even though gamers do hate the AI stuff. I was talking to someone at Costco yesterday, a Costco representative, who told me he hated the AI people. It was the same guy who told me a few years ago he hated the mining people because he thought that these people are driving up the prices and the demand of graphics chips, and that graphics chips should somehow be reserved for gamers only. That is a very naive viewpoint, my friend. That is a very naive viewpoint. Whoever gets to pay more, whoever has the ability to pay more for a graphics card, or for any asset for that matter, tends to be able to buy that as quickly as it is available on the market. Demand, supply. Demand, supply. If there's a lot of demand for a product, the price tends to go up. In case of GPUs, the price is not even that high. We are really just looking at a very small premium these days compared to the MSRP for the RTX 5090, which is their newest consumer line GPU, which is also being used extensively as an AI GPU, and people are being able to use that for AI purposes. And we are being able to actually use that right now for AI purposes as well. And if we are able to pay more for mining or for AI than gamers are willing to pay, then we tend to have instant access when they don't, and that has nothing to do with whether this is the right thing or not. So this is another aspect of inevitability that we keep talking about. Federal Reserve or Feds may resume bond purchases by early 2026. I keep showing you the WALCL chart, the federal balance sheet, which has been going down for several years now. That has caused all this panic, the sort of bear market conditions you didn't have in alt season, even though AI has driven the SPX to new all-time highs several times. NVIDIA actually became a $5 trillion market cap company for a while, a few weeks ago. But still, in general, there has been a negative sentiment about the economy. And there have been conditions that some have referred to as recession-like, some have outright called them recession. And Federal Reserve not buying bonds is one of the big drivers of whatever liquidity crunch you are facing, your business might be facing, because your customers do not really have disposable income. But that is unsustainable, as we keep saying. Politically, politicians want a solution that is sustainable, and that is not the same as letting people suffer and be dissatisfied. So JP Morgan's or Chase CEO Jamie Dimon, he has forecasted that AI could reduce work week to 3.5 days. I have to absolutely bet against this happening. And if there's a betting platform where I can bet against this happening, I would put my money now on it. If you are a business, if you're running a business, and if you need fewer employees and therefore you only need half a week from every one of your employees, would you A, fire some of your employees and lower your expenses? Or B, just have people more free time, keep paying them the same amount of money? Let me ask you again. Let's say you have 20 employees, but now you don't need 20 employees in your business because, well, there's not enough workload for them. AI is taking care of a lot of that work. Are you going to keep them all because of reasons and let them work for 3 days a week? Or are you going to let some of them go and keep only the top performers? Well, I'm a business owner and I love everyone who works for me, but I know the answer is very clear in my situation. I think the answer would be very clear for you. At the end of the day, business owners are not charities, including the CEO, this particular guy, this CEO of Chase, who's now saying, oh, we're going to have 3.5-day work weeks. It's never going to happen. Even some of the employees, they might want this to happen. You know, people who go and work for wages, they might want to have 3.5-day work weeks and take half a week off every single week for the rest of their lives. They understand that if there are other people competing for their jobs who are better at them or who are willing to put in more effort, the same 40 to 50 hours a week that they typically tend to put in right now, well, those people are going to keep their jobs, and the people who want to take the week off or half a week off every single week are not going to keep their jobs. I mean, you know, AI can enable extreme productivity. Not right now. We're going to see an example of that, either validate or invalidate that philosophy, but it is becoming better. We know for a fact it's becoming better. We know for a fact NVIDIA is making all these investments in research and development. And it's not just NVIDIA. We know for a fact that all of the major players are making investments in the AI space to make it better, to train it better, to make it more context aware, to make it more trained in terms of weights or tuning the weights. They're all doing it. And even small players, like small businesses like my own, we are also working on training AI. If we can do that in our small business, really, really small business, then large businesses that are pouring hundreds of billions of dollars into training AI, into utilizing AI, into making it more context aware, into making it more relevant with respect to its responses, well, they're all going to succeed at some point of time. Because wherever human attention goes, we see massive innovations happening. It's like the beginning of internet. Some people were like, oh, this is not going to work. Others were like, yes, when that happens, we can just chill out. We don't have to do the work. Now you can just have online shopping, and you don't have to do the deliveries, or you don't have to arrange that stuff on storefronts. Well, here's the breaking news. No matter the technological advancement, people still tend to work. In fact, people tend to work more over time. We tend to work more as a society over time, individually, than we did a few years ago, a few decades ago. more in terms of stress, higher competition. That seems to be the name of the game. So this is something that I would like to bet against, despite his positive bet on AI. So here's another concurrence. All these news reports seem to suggest that AI will get better and AI will reduce workloads. AI will take care of a lot of work that is done manually by human beings right now. That seems to be the consensus here. That is the forest for the woods. Okay, retail, as always, is a bunch of patsies. I'm sorry to say that, but retail, as always, tends to lose. Retail has nothing to do with anything except losing money. It seems to me retail investors experienced their worst trading day since April on Tuesday, when the perfect storm of disappointing earnings, legendary short seller positioning, and cryptocurrency market turmoil sent their favorite stocks tumbling. If you are retail, if you're not an expert, and how do you know if you're an expert at trading, by the way? Look at your portfolio's past performance. Look at your performance over the last 10 to 15 years. Have you done as well as SPX? Has your portfolio grown better than SPX has? If not, you're retail, and if you're still doing individual stock picks, if you're still doing intraday or intraday trading, despite having negative returns compared to SPX, you're not going to make it. Retail, it's like Warren Buffett's old quote, right? If you have a bunch of people sitting around a poker table and you don't know who the patsy is, well, you're the patsy. Retail is always the patsy. Retail that is picking up individual stocks, hoping to strike it big with that one big bet, is a lot like people buying lottery tickets to get rich, when instead they could have just, without stress, bought SPX, maybe some BTC, and have had explosive returns on their portfolio over the last decade or longer. If your returns from the past do not exceed SPX, then do not pick stocks. Do not invest with individual experts. And if you are going to evaluate an expert, might as well ask them to show you the returns over the last 10 years compared to SPX for their own portfolio, for their clients' portfolios. Anyone can make numbers up. Anyone can make it seem like they've got a secret that makes you go, that will make your portfolio go ballistic. But it really comes down to past performance being an indicator, not a guarantee, sort of an indicator of future performance. If someone really has some alpha, which is an unfair advantage, if really someone has a strategy that works consistently, at least a fair number of times, then they should have the results to back that up in their past. And if they don't, if you don't, then they or you are not ready for your own stock picks. Just stick to SPX. Okay. Retails continue to lose billions, and if you're not gonna listen to that advice, well, that's not financial advice. That's just really my take on how I would do things. I would look at my own portfolio's performance over the last few years, and if I cannot prove to myself that my portfolio has outgrown SPX over the last 10 years, for instance, then I'm putting all my money in SPX. That's it. I'm not doing any stock picks. A, it saves me a bunch of time. B, even if I outperformed SPX by like 2% or 3% an annum, is that worth sitting down and wasting so much of my life just trying to pick up individual stocks? Not really. In the long game, what really matters is time in market, but that does mean you can't really just buy one or two individual stocks that you like, because over time, every stock versus SPX goes to zero. Let me say that again. Every stock versus SPX tends to zero over time, even if for a short window, and that can be a couple of decades or even longer, even if for a couple of decades, for a short window, it outperforms SPX by a wide margin. Right now we have Nvidia, we've got Apple, stocks that have absolutely demolished SPX in performance over the last whatever number of years. Long term, SPX is going to demolish everything. SPX is an accumulated sort of a roller coaster of human accomplishment. And you're never going to outperform that. Not one company is going to outperform that, whether it's Apple or Nvidia. Everything that is doing better today will not do better than SPX over a long enough period of time. For a long enough period of time, the only thing that outperforms everything else is SPX and now Bitcoin in the crypto market. Do you have altcoins that do better than Bitcoin? Yes, but that's only for a short window of time. And we can look at that right now. Let's look at TradingView and let's look at some of the top altcoins, okay? The top altcoins being, so let's turn everything off right here. The top altcoins being Ethereum, okay? Let's look at Ethereum. Ethereum right here, let me turn that off, okay? This is the Ethereum chart. And let's look at the monthly, because I always look at long-term graphs. It has done so well, right? So well. Look at that. 29,000%. That's the kind of returns you never get anywhere else in the world. 29,000% over almost 10 years. Less than 10 years. Great returns. Now let's compare Ethereum to Bitcoin. BTC USD. Okay, check out what happened here. Ethereum topped out at 15% of Bitcoin's value in 2017. Then it had a marginal top again at 11% of Bitcoin's value. In 2018, crashed all the way down to 2% of Bitcoin's value in November of 2019. Then outperformed Bitcoin for a while, but notice how it never went back to 11% levels or 15% levels. It only topped out at like 8% of the value of Bitcoin. That was the previous altcoin season, right? Kept crashing, went down again all the way to 2% of Bitcoin's value. And now for a while, for a few months, it outperformed Bitcoin because Bitcoin stabilized for a while. It went up to 4% of Bitcoin's value. It's never ever going back to 15% of Bitcoin's value ever again. It's down to 3% again. The trend seems to me to be pretty obvious. It's tending to zero. Long enough period of time, anything will tend to zero. Let's look at something else. Let's look at Solana. Let's look at Solana. Solana, US dollar, and then I'm going to multiply that by 1,000 because Solana's value is so low compared to Bitcoin. So we're comparing the value of 1,000 tokens of Solana to Bitcoin. And when it was launched, for the first few months, it went gangbusters. So for, the value of 1,000 Solana was equivalent to 4.5 Bitcoin. And that was its peak. That was in October of 2021. It will never go back to that ever again. It has never gone back to that level ever again. The next peak of Solana, and this is when Solana did like a 30x, right, in a relatively short window from July of 2023 to March of 2024. So under a year, right? It really topped out at 3 Bitcoin. It'll never go back to 4.5 Bitcoin. It really topped out at 3 Bitcoin, and that was a very short wick on the monthly candle. Then it crashed down to 1 Bitcoin, and now it's topped out at 2 Bitcoin, and it's going down again. That's really true for literally every single asset when you compare it to Bitcoin, or for any stock when you compare it to SPX. So let's look at the Nvidia stock, right? And Nvidia has basically just Nvidia. I'm not looking at the stocks. I'm sorry. I was looking at some altcoin called Nvidia. Someone created an altcoin called Nvidia. Look at that. Just an absolutely parabolic rise. Absolutely insane. Which, by the way, goes on to show you that technology cannot be stopped, or the human ingenuity cannot be stopped. So we are looking at 168,000% right here. Those numbers sound crazy. And we're looking at 9,000 days, so that's approximately 28 years. 27 years. We've been alive for 27 years, you and I both, most likely. And 27 years ago, could you have put $10,000 in NVIDIA? I know I could have. $10,000 then would have been equivalent to what? Oh my God. The number's crazy. Is it 163 million? Yeah, $163 million. The question is, how would you know that NVIDIA is the stock to pick? How would you know that? Well, one way to know that is always to look at what you're buying. If you're buying a lot of gaming cards, buy NVIDIA. I am getting to a point in my own life where every month I look at what I'm spending money on. And if I'm spending a lot of money with Costco on groceries, then I'm going to put an equivalent amount of money in Costco stock. If I'm buying Sony cameras, then I'm going to put an equivalent amount of money in Sony stock. Anytime I buy something, especially tech related, I really should be doing this. I'm not doing it as much as I should be doing it, but I'm getting there. Hopefully within 6 months, I'm going to change it and make it a habit to actually invest as much in the stock of any particular company as I do in its products. So if I buy a new Apple MacBook Pro for $7,000, I'm going to buy $7,000, at least $7,000 to maybe $15,000, $14,000 worth of Apple stock. If I buy a graphics card or NVIDIA's DGX Spark for $4,000, and if I buy 3 of those, that's $12,000, then I'm putting at least $24,000 in NVIDIA stock. That's really the only way to go with tech, because you know for a fact that when you invest in tech, you've done your research, you know for a fact that's the best product for your needs. And unless it's a complete hobby, and even if it's a complete hobby, it's fine, as NVIDIA has proven, right? Gaming, it was a gaming card. They used to call them gaming cards. Gaming cards used to be synonymous with graphics cards. GPUs used to be called gaming cards, and now look at what they're doing. The applications were found later. The applications related to machine learning, the applications related to cryptocurrency mining, or massive parallel distributed compute were found later. It was just a design tool and a gaming tool for the vast majority of its historic rise. Having said that, over the long term, I'm going to bet S&P 500 is going to thrash NVIDIA. Has it done so now? No. Is it doing so right now? Probably not. Is it guaranteed to happen over the next 10 years? Probably not. Here's the other thing, is the flip side to that. Did you know about NVIDIA? Probably not. Probably not. For a long time there, NVIDIA was a tiny player. You did not know about NVIDIA, you did not know about Apple, and you probably will not know about the next company that does or outperforms NVIDIA and outperforms the SPX for an extended period of time. What you do know for a fact is it will be sooner or later a part of S&P 500. That you know for sure. Once again, look at your own portfolio. If your portfolio has done better than SPX, all power to you. You should be doing your own stock picks. But if your portfolio's performance has not been as good as SPX, then you really should not be becoming a part of this statistic of retail investors who lose their money every time whales move or every time markets move. Google Finance is now going to integrate prediction market data. I don't know if it's going to be valuable or not. All I know for a fact is this indicates more that AI is going to lead the next few years of technological revolution and technological investments, which is what we care about. And AI is going to get better, which is also what we care about, which then means that since AI is getting better, you should be incorporating more of that in your business. And in the second part of today's stream, I'm going to show you exactly how you can get started. Even if you have no technical background, I'm going to give you an example today. So let's keep going. Last week, we had a global market meltdown, and Bitcoin crashed to under $100,000 for a moment there. Now, global markets are rallying again because Senate is advancing the bill to end the shutdown. These are always short-term moves. If short-term moves become panic-ridden situations for you, maybe you are over-invested. Also, nobody knows what's going to happen over the short term. The experts really only always talk about the short term, relatively speaking. Nobody's thinking in decade terms. Nobody is thinking what happens until 2050. I'll tell you what happens until 2050, and I'm relatively sure this will happen. Gold will continue to keep up with inflation. Sometimes you're going to have periods where it lags behind the market, and then it's going to shoot right back up. We saw that. Bitcoin, unless something major happens catastrophically, technologically speaking, to Bitcoin, it's going to continue its run, but it's not going to be as parabolic as it has been. That's just inevitable. What's going to happen to SPX? SPX is just going to continue to make new all-time highs, really. What about NVIDIA? NVIDIA is going to lead for a long time. Will it sustain its run until 2050? Nobody knows. Nobody knows for sure. Nobody can say for sure. Will Apple be one of the top companies in 2050? You cannot know that. It might very well be, but look at what happened to Starbucks. Starbucks was a major success story taught in all business schools. In Harvard Business Review, they always featured Starbucks and its success story and how they redefined the third place and how they redefined the category. And they went from being a cafe, tiny little cafe in Seattle, within a few decades to having thousands and thousands of stores worldwide. Now we have the exact opposite problem. Starbucks has so many stores, but people do not consider it to be a premium alternative or a premium coffee destination anymore. Starbucks is struggling. When was the last time you heard about Starbucks in the news about how gangbusters their performance was going? I would have to say I haven't heard anything positive about Starbucks in the news for a very long time. So it took less than 2 decades to go from media favorite to being relatively obscure. For Starbucks, which is a major corporation, still a giant behemoth. Can the same thing happen to NVIDIA? Yes, yes. Can the same thing happen to Apple? Yes, absolutely. Can the same thing, can you say that this happened to other companies in the past? Yes, IBM. Great big giant behemoth even today, but when you talk about technological reforms or technological leadership, IBM is not the corporation you think about. You talk about NVIDIA today, about Apple a few years ago. Nobody's talking about Apple being a revolutionary tech company anymore. And if they are, good for them, you know? It's just opinions. At the end of the day, what matters is price. The price of the stock, the price of the goods, and the revenues, and EBITDA. So, short-term movements, if they are scaring you too much, maybe you are over-invested in the market. You should be under-invested. You should never put all your baskets in one egg. Me, I'm very happy just buying SPX for the rest of my life because my time frame is not 2 years from today or 2 months from today. I don't need to make money by February. I don't even need to make money by by 2035. I'm okay working because I'm relatively young and I hope to be young, and I'm very thoroughly interested in the kind of work that I do. So I'm very happy working for the next 30 years or 50 years. I'm really hoping to stay fit so that I can continue to work well into my 80s if I can still work then. And I hope I can. That's my bet. My bet is that technology will get so good that we're going to have technology for human healthcare that enables me to work when I'm 80 years old because I enjoy my work. And even if I had all the money in the world and I did not need to work for money, I would still continue working. Why? Because what else am I going to do? Just scroll Twitter? Is that what I'm like? What else can you do? So, short-term movements do not scare me. If they do scare you, your time frame is wrong, your expectations are wrong, and you're worried about the wrong thing, or you are over-invested, or both. Here's another piece of news that goes on to show you that AI is going to continue to dominate the next few years of technological leadership because Metropolis has now raised $1.6 billion to expand AI parking tech. So AI is coming to real-world applications like parking, which brings me to a piece of, I would say, introspection that you should have right now. Do you really have strategy for AI working in your business? Do you at least have some ideas of how to make AI work within your business? How can you take AI and help it or let it help you cut out expenses from your business, or scale technology within your business, or help your business become stronger structurally? Do you have any plans with respect to that? Because if you don't, you might be in for a very hard time. AI is just a buzzword if you don't know what to do with it. Oh, it's AI. Well, the easiest way to participate in the AI boom is just to buy NVIDIA stock for now. And in general, if you want to participate in the technological growth of the world, just buy SPX, because technology or technological companies are going to be at the forefront of SPX for a very long time in the foreseeable future. That's it. We can clearly see that AI is going to continue to get better, because it is getting better, and AI is going to continue to receive investments, because you see these pieces of news every single day, and you need to think about how to take advantage of AI beyond just investing in SPX or NVIDIA. PNC, Rothschild, they both disclosed their Solana ETF holdings. And this is something that absolutely staggered my mind. $132,000. And I had to do a double take just to figure out what was going on. They hold like 133 grand worth of Solana ETF. And PNC Financial Services with 569 billion under management. 1,543 shares at 32 grand. Really? In other words, they don't have any Solana holdings. What does that tell you? They understand that long term, no altcoin, including the best ones like BNB, Solana, Ethereum, they cannot keep up with Bitcoin. Because historically they haven't, and long term they probably won't. This is despite the fact that Solana has been leading ETFs with $127 million in weekly inflows, so bringing its historical total to $324 million. But Rothschild and PNC, they have like 32 grand or 150 grand worth of Solana. Goes on to tell you that in a lot of cases, it's just retail investing in altcoins. It's always going to be P versus P. Person versus person, individual versus individual, dog eat dog in the altcoin world as it is in the individual stock picks world. And once again, just go back to your own results, your own portfolios, whether in crypto or in stocks, and look at whether they've outperformed Bitcoin or SPX respectively over the last few years. And if you haven't, maybe just stick to the big ones, huh? So this is, in essence, what I was talking about. I'm hoping over time technology will make you more healthy and solve health related issues over time, which will allow me to work for the next, whatever, 100 years or however long I can hopefully live, because I do enjoy my life and I do enjoy working when I'm still alive. Another piece of news, 1 in 6 UK employers expect AI to cut jobs. So, like I said, job cuts are an inevitability. That's just going to continue happening. We're going to talk about the inevitability and what that means for your business. Let's keep going. And finally, okay, that brings us to the end of the news section for today. So let's talk about the inevitability that I really just wanted to talk to you about. What is inevitable? You have job cuts. That's absolutely inevitable. You're having them now. You're going to continue to have them over the next several years. You're going to have them. There's just no way this will not happen. Prices are always going up. Prices for what? For everything. Everything gets expensive. When the Fed raises the rates, what they're trying to do is bring down the inflation to 2%. They're not trying to lower the prices. In other words, prices are like a cat out of the bag. Prices, once they go up, they never go back down. Wages have been stagnant. We've had you don't have to go to the reports or studies for that. You just know from your own wages, right? If you know someone who has a wage, or if you work for salaries, you know that wages have stagnated as compared to the prices of everything. Interest rates have been high for several years. They're coming down. But Powell already said that December FOMC meeting will have rate cuts is not going to be a foregone conclusion. It's definitely not guaranteed. So interest rates are pretty high, which has kept the real estate market in a glut. We've seen several people talk about it, and you can see the inventory levels. You can see what's going on in the real estate market. A lot of people find houses are unaffordable while the sellers are unwilling to budge, especially since, or in many cases, when they already have locked in long-term 30-year mortgages at like 2.5%. Why would they want to sell that and go and buy something else at 6% today? We have runaway inflation, of course. And we have massive dissatisfaction, which is evidenced by the gubernatorial elections last week, where GOP had their backside handed to them by the Democrats. It's not because people really like Democratic policies or Democrats. It's mostly a lot of people just expressing dissatisfaction with the way things are going right now. Now, I'm politically agnostic. I don't really believe in terms of, ideology aside, I don't believe in political solutions to finance and business. What I do know is what is inevitable is this stimulus check. Is it coming? Maybe, maybe not. Maybe this year, maybe next year. Most likely, yes. And it could come in a variety of different ways, as we've seen. 50-year interest, 50-year mortgages instead of 30 years. So you have slightly lower payments. Hopefully, significantly lower payments. All of that is intended to put more discretionary income into the pocket of the average worker, the average consumer, the average voter. Stimulus could just be a stimulus check. If you're qualified, if you are below a certain threshold of income, or just generally everyone, which we've seen happen during COVID. Stimulus could also be, hey, let's make healthcare more affordable by letting people choose their own healthcare, which is also something that Trump has proposed recently. And then we also know Fed cuts are coming sooner or later, maybe not December, okay? Is it guaranteed in December? No, but they are coming. Trump has already, at several occasions, expressed his dissatisfaction with Jeremy Powell, who has said that it's probably not going to be a soft landing, or probably we're going to have continued high interest rates. But eventually, what else are they going to do? They can't have unrest, or they get replaced. And the next politician does what they're supposed to do. Politicians understand inherently that when people do not have the kind of money that they need, when people do not have this illusion of financial security, even though for a long, long period of time, a lot of people in the world, also in America, have not had a great big discretionary income and great big financial spending, positive financial spending habits, and in a lot of cases they don't have even $500 or $1,000 to cover their own emergencies, and they have to rely on credit cards to do that. But if the interest rates are high and credit availability is low, then people become really restless. And that is something no politician can have for an extended or prolonged period of time. And then finally, WALCL. We have now seen indications, or at least predictions, or at least some sort of clarifications or hopeful statements from a lot of people that WALCL is going to stop selling assets and start buying assets, hopefully soon, hopefully as early as next year. And you're going to see a lot of retail just flood back into altcoin gambling and a lot of stock market gambling. So if you're well positioned, at least you can take advantage of that. If your business is well positioned with great offers, at least you can take advantage of that. And how do you position your business well to take advantage of that? Well, do you have all different payment methods, as many as possible? AMAP is like ASAP. Get AMAP ASAP. As many as possible, as soon as possible. Okay? Offer as many payment methods as you possibly can, because remember, your customers, they only have as many payment methods as they use. And if they want to use Apple Pay, but you don't offer payments via Apple Pay, you're missing out. If they want to use Zelle or credit card or debit card, and you don't want to use that, you're missing out. If they want to use cash in your retail storefront, but your credit cards only or electronic payments only, you're you're missing out. So get as many payment methods as possible. Try supporting as many payment methods as possible. That alone, in many cases, I've seen businesses that, I saw a shop that, there was a storefront that I thought about acquiring, right? It was a fast food thing. Great margins, organic stuff, 2 stores. That's it. And they were doing this despite having a no cash rule. So they did not accept cash payments. It was working out okay because everyone has some sort of other payment method outside of cash. My plan, if the acquisition went through, was to immediately institute more payment methods. Why? That would probably increase the sales by 5 to 7%. Doesn't sound like a lot, right? When you consider that the hard costs, the labor costs, because people were on a salary, salary and tips, and then the location costs or the rentals, that does not change. But if you go from $2 million to $2.1 million, the only extra expenses you add are the tiny variable costs of goods sold, which in a lot of cases, in the case of that particular restaurant, would have been 0 because they were literally throwing away stuff because their USP was fresh. Okay, so they were throwing away ingredients at the end of the day. So extra sales would have been basically money in pocket, and that's it. 2% extra, I would take it. $40,000 a year. That's, that's the salary of a mid to low income worker. The annual salary for just adding cash as a payment method. So definitely add as many payment methods as you can. If you have an online storefront, make sure try to get Affirm and Klarna and buy now, pay later options, as well as cryptocurrency options if you can offer that. Of course, I'm not a tax advisor, so you need to talk to your accountant about that. But as many payment methods as you can offer would be better. Another thing is, do you have clear call to action on every single page? You have pages within your funnel, right? A landing page where someone comes in and looks at what's going on, an offer that they might be enticed to take. Well, you need to have a very clear call to action. There's another call to action. What do you want them to do? Do you want them to buy something? Do you want them to opt in? Do you want them to spend some money with you? Do you want them to spend a small amount of money with you or join you for a free trial? Have a very clear call to action on every single section of every single page of your funnel. Strong product market fit. We've talked about this all the time. If you have a great product market fit, if you know who your audience is, and if you know what your product offers to them, remember, they don't want your product. Your product is just in the way of them getting the results that they want. They want the results. So if you can demonstrate via product market fit that you have what they want, which is the results, that's a great way of positioning your business. What else can you do? Deep funnels. There's this misconception going on right now that you're either like a fast-paced e-com business or an e-commerce business, or you're a long-term brand builder. Here's something that I need you to understand. You can be both. You can be a short-term, fast e-commerce client acquisition machine while also being a long-term brand. You don't have to pick one or the other. If you have the ability to acquire clients quickly via e-com methods like surf scaling or testing a lot of ads very quickly, very cheaply, that's a great strength to have. But if you're not building a deep funnel on the back end, if you don't have a host of products that they can enjoy, your customers can enjoy, then you're literally leaving money on the table. You're only making money on the first couple of sales, and that's it. You don't have anything else to offer to them. You don't have funnels that tell them why they should be buying more of your products to solve more of their problems. And as a result of that, you're missing out. So you need to have deep funnels and hopefully years of relationship with your clients and customers. Years of a relationship. How are your unit economics? Basically, customer acquisition cost, break-even period, and lifetime value. This is a mathematical way of saying the same thing as deep funnels and fast e-commerce like acquisition of customers. What are your KPIs? Do you know your KPIs? Do you have dashboards to look at your KPI every single day in real time? And finally, it's cash flow management. Payment methods, clear call to action, strong product market fit, deep funnels, unit economics, KPI and dashboards, and cash flow management. If you have these things lined up, remember, sooner or later, interest rates will go down. Sooner or later, your customers, the ones that you have great product market fit for, will have discretionary income, and sooner or later they will have the ability to spend a lot of money buying your products if only you have deep funnels and a lot of products to offer to them, instead of just 2 products on the front end of your website trying to make $100,000 a month and calling it a day. Listen, if that's what you want, that's great. If you're just getting started and that's all you want, that's great. But eventually you're going to have to pivot to building a long-term brand, having a product that actually solves the problems that people have, putting some money into research and development, pouring some money into finding solutions for your audience, and then bringing those solutions in the form of products to them to buy, for them to buy. Okay, so now moving on to the next section, and this is a very exciting section. I keep talking about AI, and today I just want to show you how AI actually potentially works. So this is Claude Code. Claude Code is, think of an agent, okay? Think you're the CEO of a company, and then you have a CTO or a Chief Technology Officer, right? And you can explain to your CTO what your requirements are all about in plain English. And then your CTO goes out and works with his team to develop the software implementation of those products. Well, that is what Claude Code is all about. You can start using it today. If you're not using it within your business, you can start using it today. And here's what I said to it. I said, you're to design an altcoin trading bot. Here's what we need from it. And I gave it very specific instructions. We need it to be paper trading, but it can also be switched to live trading if we like the performance. It pulls data every 15 minutes, keeps a local log in a database. It works with top 100 assets available with OHLCV, open, high, low, close, and volume data based on trading volume top priority. That's our first priority. How do you select the assets? So that's the asset selection criteria. Logs all trades with asset names, opening and closing prices, time in trade, units bought or sold, fees paid on entry and exits, and I gave it parameters when it's simulating that data or simulating trades via paper trading. Initial portfolio value is 10,000 USDT. USDT is liquidity. It's the only stable coin in the system. Ignore all other stable coins. Everything else is an asset, no other stable coins in the system. No pyramiding, which means if you have, let's say, $200 worth of Ethereum, you buy another $150 worth of Ethereum. So you're buying 2 positions into the same asset. That is known as pyramiding. No pyramiding, no partial exits. So if you have, let's say, 5 Ethereum, you only sell 3 Ethereum, that's a partial exit. If you sell all 5 when you want to sell, that's your complete exit. Position size is fixed at 5% of available liquidity. Now I had to specify because I know that AI does tend to make this mistake. It has made this mistake in the past. So I had to specify this is not the same as portfolio value. We're only talking about available liquidity. And you're going to see it makes that mistake in the thread as we are discussing it. And then finally, I gave it the entry conditions. Basically, it's just a EMA crossover, right? Fast EMA higher than slow EMA. And how do you separate noise from signal or signal from noise? Well, either the RSI is oversold or the difference between 2 subsequent closes is greater than 0.1 times 10-day ATR, average true range. And then it's like exit any open position immediately if any of the following conditions are met: 25% stop loss from entry, or 30% trailing stop loss from any paper value achieved by that position, or signal reversal, which is slow EMA crosses over the fast EMA from below. And here I made a mistake because I previously told it at the time of entry that slow EMA would be 48 days, 48 daily closes, and fast EMA would be 12. But I mistyped it. I meant to say 48 day here, but I mistyped it as 18, and you're going to see it actually comes back to clarify that with me. And then I clarify all entries use up liquidity, all exits free up liquidity. For all trades occurring at same timestamps, exits first because they free up liquidity, and then entries. And report daily progression of portfolio value and breakdown by cash versus held or active positions as percentage. So the portfolio value is $15,000, of which $9,000 or 60% is in cash, and $6,000 or 40% is in positions. If you have any questions about this before you start, and ask me now. So this is the set of conditions, a very detailed set of conditions that I gave it. I gave it a blueprint to build out something for me. I don't know coding. I am not great at coding. So we're going to see what it does. And over the next few live streams, we're going to evaluate the performance of the trading bot it built. Today, however, we're going to talk about intelligence in action. And so I asked if it has any questions, and Claude then comes back to me and says, I have several important questions before I start designing and implementing this trading bot. So first thing, it pointed out there's a mismatch in the data timeframes, right? So it says you said daily closes should be 48 daily, but then you said it was 18 daily. So I had to clarify. No, I just meant 48. 18 was a mistype or typographical error. Secondly, they said, did you want daily time frames or 15-minute time frames? And I said, pull data every 15 minutes, but trade once a day, okay? And then it wanted more details about RSI, because I just said RSI should be oversold, right? And it said RSI oversold threshold. What RSI period do you want, and what threshold do you want? And it wanted more conditions about ATR. You mentioned 0.1 times 10-day ATR. Confirm this 10-period ATR. So it wanted confirmation on a lot of things. It also said you had discrepancy 48 days versus 18, so we cleared that up. EMA crossover timing, it wanted clarification on that, and then it wanted technical details. Now here is where it asks me technical questions, some of which I'm not prepared to answer myself. Why? Because I really don't know how Claude Code works and which frameworks it's best at using. So I don't know which tech stack they should be using, right? So Claude asks me, which API should I use? CoinGecko, CMC, Binance, Coinbase, other. And then database system, which database system do you want? Which programming language do you want? And then it wanted to know trailing stop clarification, 30% trailing stop from highest value since entry, right? And so I respond to all those. I said collect 15-minute data and aggregate it into daily candles. Once a day is right. That's the trading frequency. 14 RSI, 30 oversold threshold, 10-day ATR. I gave it the answers. But here's what I want you to notice. Multiple data sources for redundancy, I said. And so I let it decide which data sources it's going to use, right? Then I said, whichever you think is suitable, I do not have a preference related to the database. I just need robust data handling. I need it to be robust. I need it to be reliable. Then same thing about programming languages. I said, up to you, whatever you're most comfortable with. Again, I have no preference. I just need robust performance. And finally, yes, trailing stop loss, highest value since trailing stop loss, since entry. So then it has a few more clarifications. It says, well, you need 48 days of data in order to be able to calculate 48 EMA. So how do we get that? And do you want to start with a backtest versus live trading? Then it has questions about trading logic, concurrent positions. And here is where it makes the predictable mistake. It says with 5% sizing, the theoretical max is 20, but the practical max depends upon signals. And I respond with this, because I already foresaw this coming. I said theoretical max for concurrency is not 20. Every position is 5% of available liquidity. Therefore, if the first position is $500, the remaining liquidity is $9,500. Therefore, the second position is $475. Therefore, even after 20 positions, you'd have about $3,584 remaining, assuming none of them close or produce exit signals, right? Even after 50 concurrent positions, no closes, starting at $10,000, you'd have $770 left. So you don't need artificial limits here. The position size keeps getting smaller as the available liquidity within the portfolio keeps getting allocated to open positions. And finally, it has other questions, slow EMA, ATR conditions. So it's talking to me as a CTO would. That's the important point here. It's talking to me as if you were my CTO, you were designing the system for me. It's talking back to me. It has questions for me. It lets me make those clarifications. And then finally, with those clarifications, it allows me to clarify essentially what I want, as I would to a CTO, even if I did not know the technological half of it. So now it says, perfect, all clear. Let me design and implement this trading bot for you. So summary of what I will build. Now it specifies the tech stack it's going to use, because I told it, I don't know about the tech stack. You decide what is going to be robust enough, reliable enough for the system. It says we're going to use Python and PostgreSQL. Data sources are going to be multiple APIs. GUI is graphic user interface. It's going to be Flask-based, responsive web dashboard. And scheduling is going to be continuous process with APS scheduler. So project structure is going to be data collection and aggregation, strategy engine, paper trading, portfolio and liquidity manager, trade logger, reporting system, web dashboard. And then it went to town. It literally just went to actually going ahead and building that out for me. Right here, you can see it created a to-do list for itself. It started coding. Okay, and this is all Claude Code just doing what it does best. None of this is coming from me. It's just creating these to-do lists and just checking them off. It's been going on. In fact, I don't know what's been going on because I've been talking to you. So let's see how far along it is. And you can see most of the to-do list is already done. So we can expect within the next couple of hours, this was just an hour really. Within the next couple of hours, it'll have something for us. Will it work? I don't know. Is it likely to work? I don't know. I really don't, because it's a complicated system. Can it work? Yes. Here's the thing that you need to take away. Even if it doesn't work today, in a couple of years, Claude Code will be at a position, and Claude itself will have a system for creating complex code. We're looking at thousands of lines of code here. You would need a team of developers for weeks to be able to come close to doing this. If you had one developer working on this, it would probably take months, if not years. And we're talking about an expert with decades of experience in coding. This is just me giving it instructions in plain English, and it's probably going to come up with something which we're going to discuss in the next few live streams, see how it does. If you're actually interested in how this live trading bot performs, subscribe and make sure you watch our subsequent streams, because this is going to be very exciting if it works. If it doesn't, we're going to try it again in a few months with maybe Claude 5.0 or something, right? Right now, the version is 4.5. What really interests me is that not the trading system itself, because trading system is essentially just an algorithm based on the conditions I gave it, and it works, it doesn't work, it's irrelevant. What is relevant is that Claude Code can go out and build out a multi-file system with inner dependencies, with thousands of lines of code, and can work on it all by itself without asking me any of the questions that it would need to ask, or a tech developer would need to ask in order to design this, because I'm not a techie. I don't know the technological implementation here. I don't know the coding languages here. I can't even read code very well. But it can go ahead and do all of that without needing me to babysit it. It does not take a day off. It can get weeks of work done within hours, months of work done within days, years of work done within weeks. You can fire an entire team of developers, if not today, at some point of time within the next few years, and you'll be able to fire an entire team and get the work done by AI. And why do I know this will happen? Because of the amount of investment, not just in terms of money, but also skill training, context management training, and just model training that is going on with all these AI companies worldwide. It's just happening at breakneck speed. This is why I know we are going to inevitably have these job cuts. We know for a fact that inevitability is coming for your job. No matter what you do, it's coming for your job. Unless it's something that human beings cannot be replaced about, like a sales job. You know for a fact that all these other factors are eventually going to lead to stimulus money, and you can position your business to take advantage of AI and take advantage of the upcoming inevitable money printing, because that is what has historically always happened. And it's not just in America, it's in all massive empires throughout the history. So that brings us to the end of today's session. I was really excited about showing you how Claude Code is actually building out something that, this would be impossible to imagine even just 6 months ago. 6 months ago, when I was talking with ChatGPT, it would write a piece of code and give it to me to run on my servers. And if it had any errors, I would have to come back and tell ChatGPT what those errors were. And then it would rewrite that code and be one painful file at a time. Now what we have here is thousands of lines of code across hundreds of files, dozens of files within a complex system that Claude Code is building all by itself. Even using AI, something like this would have taken me, let's say, several weeks and would probably have failed, because it did fail when I tried it months ago. Potentially now can get built by Claude Code all on itself, with just front loading it with a little bit of information within a few hours. And if it works, great. If it doesn't, in a few months it will, because Claude will get more advanced. So we're not talking about trading bots here. We're talking about getting Claude Code to do things that you want it to do within your business. In other words, if you think your company or your business is not technologically advanced, well, now you don't have to be in order to harness the technology. Sooner or later, Claude Code will get so good at this. It's not just Claude Code, right? All AIs will get so good at it that they will literally deliver the algorithmic version of the code that you need for your business, no matter what business you're in. That means great news for anyone invested in AI. Long story short, and bad news for anyone who can be replaced by AI. If you're a junior dev, might be coming for your job. Maybe it's not good enough today. But don't rest on your laurels. It is coming for your job. If you're working for a big entity, big organization, they know that this is coming. Performance reviews will take thousands and tens of thousands and hundreds of jobs away from just human developers. And it's not just developers, it's also graphic design artists. It's also copywriters. The real ingenuity or the real value of human intelligence will always be vision. Being able to decide what it is that you want to do within your business, being able to make that strategic decision, that is something AI will always struggle with. But other than that, I don't see a lot of things that AI struggles with. You can see as we're talking, it's just working behind the scenes, writing thousands of lines of code across hundreds of files. Look at that. It's mind-bending, really. So get positioned for your business to take advantage of the inevitability. How do you do that? We talked about that today. With that said, my name is Lakshya Behl. I had great fun talking to you today. I think today's stream was very interesting. Once again, remember, over the next few streams, we're going to show you how Claude Code is working and building out the software implementations that we needed to build, and how that actually performs. Maybe not in a complex system, maybe in a relatively simple algorithmic system, but we're going to see how that works. We're also going to start inviting business owners to the stream, and we're going to ask them 2 specific questions. The first one is, what's working right now for your business? What's working well within your business right now? What has helped you get to this point? That's the first set of questions. The second set of questions is, what's preventing you or bottlenecking you from where you are today to the next level? So if you're making $5 million top line today, why are you not at 10 million, 25 million, 50 million, 100 million? What's holding you back? Because in most cases, it's not your total addressable market. It's not your TAM levels. It's literally a bottleneck within your own frame of understanding in most cases. So we're going to talk about that. And if you are interested in joining us for being interviewed on the stream, in the next few streams, I'm going to give you a way to do that, to apply for that. With that said, subscribe, hit that like button, leave a comment below if you have any questions, and I'll see you in the next stream. My name is Lakshya Behl. Have a great day.